Okay, so the Nigerian markets we heard earlier on were down in general 21% for all of last year, and certainly this industrial action will have an additional bearing. What sort of bearing do you think?
That's what we really like to find out from our guests. But I mean, obviously, it's a big dampener for the market. Yeah. The market is already dealing with quite a bit with higher interest rates, and that was making equities less attractive to investors. On top of that, we also have the crisis in the Eurozone and just general weak sentiment across the world. So it's really a tough time for Nigerians, and then we start with this again.
Just before you go to your guests, just give us a very brief synopsis as why this fuel issue is such a political hot potato in Nigeria.
Well, it's really a question of what can the people, that's the argument of protesters, what can we get from this government? Over time, you know, with the history of corruption in Nigeria, there's a view that this cheap fuel is really the only thing that the common man can get from this government. Unfortunately, we've not seen most of the strong macroeconomic performance, GDP growth of 7%, translating to better standards of living for most people. That's why they are protesting.
All right, let's get some analysis.
Indeed. Let's cross now to Chibuzo Ivenso. He's the head of research at ARM Investment Managers. Chibuzo, it's good to have you on the show. First of all, let's get your thoughts on, like I said, this is a huge dampener for the market, but how bad can it be? We've already dealt with higher interest rates. What are your thoughts on the impact that this might have, broadly speaking, on the market, before we go to specific sectors?
Okay, hi, Wole. Good afternoon. Well, you know, this has been expected. The labor unions have spoken about the strike for quite some time now, and therefore, the market has been anticipating it. So really, you know, it's just early days, and nobody has any idea how this is going to play out. So it's really a question of what happens next. Over the next couple of weeks, the way the strike and all the incidents that go on around it play out will really inform what the market reaction will be going forward.
Right, we'll see how it plays out. But obviously, the common man has taken a big hit from this move. But which sectors, in your view, are taking the biggest hit? And we know that, for instance, the consumer companies were the star performers last year, but there's a view that this has a huge impact on consumer purchasing power. What are your thoughts on the impact that this will have on these companies?
Well, certainly it will. I mean, this is a huge dampener on disposable income. And interestingly, many of the consumer companies have started adopting some kind of premiumization strategy. In other words, moving into higher-end products. Therefore, I mean, with the kind of impact that this is likely to have on disposable income, those are probably the ones that are going to be affected more. And we're taking more of the packaged goods producers. You know, basically the food industry especially is divided into the packaged goods and the primary goods producers. And the packaged goods producers are at the higher end and therefore more susceptible, more vulnerable to declines in disposable income. For the other food producers, perhaps the impact might not, because they deal with staples mostly. So the impact is not likely to be as much. But to the extent that, as I said, this has been anticipated by the market for a while, perhaps the impact may not be as drastic. There's a sense in which market has already begun to pricing some of these events into stock prices. We're likely to see generally a muted effect.
All right, so the consumer companies will take a moderate hit in your view, but which will be the winners in your view? Many people are thinking the petroleum marketing stocks, because as we know, the margins on sales for fuel with the subsidy has been very, very low. There's now a view that if you deregulate, there's now a chance for them to get higher margins. But in the short term, there's a view that there's going to be a decline in volume. So it's a really interesting scenario there. What are your thoughts on the winners from this?
Okay, well, I think there are two issues. There's one, volumes are likely to decrease, obviously. Prices have risen drastically. But perhaps the impact on actual sales may be different. You know, the price, the template for the subsidies is not quite clear, but it's quite likely that the regulation may bring more reflective pricing and therefore somewhat support sales. But I think the key impact will be on margins. And I think the key issue there is operational efficiencies. The market prices are essentially going to be set by the efficiencies of the more dominant players, and it happens that is the NMPC, and it's the NMPC's pricing template reflects a lot of inefficiencies in its own supply. And for many of the marketers that are able to move in their products at much greater efficiency than NMPC, are able to capture a significant margins from that. But then, of course, the impact is not uniform across the sector. Also, you have those that have been invested significantly in supply chain efficiencies, built floating storage platforms, and able to ship products quickly into the market. Also, it also impacts cash cycles and therefore financing, which is a key component of cost for petroleum marketers. So I think the key word to watch out for in that industry is efficiency. And several like Wando and Corn Oil, for instance, have done a lot investing and building capacity in that area. So we're looking to see them improve their margins so much as to offset whatever impact, negative impact we might see on sales volumes.
All right, Chibuzo, unfortunately, we have to round up. Thanks so much for your thoughts. Chibuzo Ivenso is the head of research at ARM Investment Managers. So, Lerato, if he said it all, I think it's going to be a tough year. We'll see how it goes.